In the last 12 months, healthcare stocks have been the worst performing sector in the market. So is there a 50 to 100% upside from current levels? Well, let's find out in this video. Now, over the long run, healthcare stocks are one of the best sectors to invest in because there are only three sectors that beat the S&P 500 over the long run. What are the three sectors? Technology, consumer discretionary, and you got it, healthcare. So in this chart, you can see that over the last 25 years, the healthcare sector, which is measured with the XLV ETF, is one of the only three sectors that really outperforms the S&P 500. Why? Because first of all, we know that healthcare is in a secular growth industry as the global population is aging and people get more and more chronic diseases, number one. Number two, healthcare is recession proof because in a worse recession, you still got to take your drugs. You got to still go to the hospital. So it has both the combination of being defensive, recession proof, as well as being a growth sector. However, in the last 12 months, something unique has happened. In the last 12 months, the healthcare sector has been the worst performing sector in the S&P 500, where there are altogether 11 sectors. So you can see in the last 1 year, healthcare as a whole declined 29%. Worst performing sector. Now, so the question is, why has this happened? And is this an opportunity to grab some high quality healthcare stocks? Now, first you have to understand that not all healthcare stocks went down. Within the healthcare sector, it's divided into various subsectors. So first you have got drugs or pharmaceuticals. So generally pharmaceutical stocks have not been doing too well or have been underperforming. So that has pulled down the whole sector. Next, healthcare companies, managed healthcare companies that include companies like UnitedHealth, Elevance Health, they have also been underperforming the market. In fact, the big elephant in the room, UnitedHealth, which I'll talk more about later on, is down 24% for the last 1 year. Again, we'll find out why. Is it temporary? Is it long term? And is it an opportunity to grab shares of this market leader, right? Then you've got diagnostic equipment, medical instruments, that has also underperformed. So in other words, drug manufacturers, managed healthcare, and medical diagnostics and biotechnology have all been the ones underperforming in the healthcare sector. The only subsectors that are outperforming are medical devices and medical facilities, of which I own them as well. So in fact, I own the IHI ETF, which is the medical devices ETF that has been performing relatively well, in fact, compared to the market. I also own a company called HCA Healthcare, which is the largest private hospital chain in the US. That has also been doing relatively well or outperforming, right? But again, where I see a lot of potential opportunity is to look at the ones that have been beaten up, the ones that have been really underperforming, and to only buy the highest quality names within those beaten up sectors. So if healthcare stocks, generally in the long run, they tend to be outperforming the S&P 500, why have they sucked in the last 12 months? And how can we take advantage of this short-term sucking to grab them when they're cheap before they start to outperform again? So there are four reasons why they have been underperforming. First reason, number one, is because healthcare as a sector is a defensive sector which is out of rotation. So what does this mean? It simply means that money has been flowing out of the healthcare sector. Why? Because remember, in the long run, the stock market is a weighing machine, which means companies that make the most money, they are priced higher in the long run. But in the short run, the market is a voting machine. It's like a beauty contest. Mr. Market is a very fickle-minded lover. His taste keep changing in the short term. So sometimes he loves financial stocks, so all the money flows into financial stocks like now. And he hates healthcare stocks, so the money flows out of healthcare stocks. So we call this sector rotation. So sectors take turns getting in and out of rotation. So it so happens that the last 12 months, Mr. Market has been pulling money out of the healthcare sector, which he doesn't like in the short term, into sectors that he does like. For example, financial. So financial stocks have become like booming and healthcare stocks have been going down. So as a value investor, we like to look at sectors that are out of rotation, where money has been flowing out. Because when money flows out of a sector, guess what? Most of the companies in that sector, the market price will all drop, whether it's a good company, bad company, or normal company. So our job is to pick the great companies that are temporarily mispriced because money has been flowing out of those sectors, the sectors out of rotation. So that's the first reason. Healthcare is simply out of rotation. But it's a matter of time where money will then rotate back into the healthcare sector. Exactly when, I can't predict. Could be next month, could be next 3 months. But once money flows back into the healthcare sectors, then all the healthcare stocks would all go up. It's kind of like the tides, right? The low tide and the high tide. So there are times when the tide goes out for healthcare, and there's time when the tide comes back in. So now that the tide is out is the time when we want to pick up seashells on the beach before the tide comes back in. So that's the first reason. The second reason why healthcare stocks have been sold off is because of policy and regulatory uncertainty. So some of you, especially if you're following US politics, you know that this guy called Robert F. Kennedy Jr. Was appointed the Secretary of Health and Human Services in late 2024, appointed by Donald Trump. And this guy is known for being a bit of a radical, right? Where he was anti-vaccine, and he wants to change a lot of the way drugs are priced and stuff like that. So the market hates uncertainty. And whenever there's a lot of uncertainty when it comes to regulations, the market dumps those stocks. And hence, many healthcare companies, especially drug companies and biotech, have been dropping because of the uncertainty of the new Trump administration. Now, as an investor, is it something we should be concerned about? Well, if we are a long-term investor, then it's something that we want to take advantage of, because these regulatory and policy changes are always short-term. And once there's certainty, money flows back into the sector, and the companies will be priced based on their intrinsic value. So right now, many are undervalued because of this uncertainty. People dare not commit more money to the stocks when there's policy uncertainty. The third reason is because of high interest rates. So ever since 2022, because of high inflation, the Fed, as you know, has raised interest rates aggressively. Now, when interest rates go up a lot, there's one part of healthcare that doesn't do well. It is called biotechnology, biotech. Because a lot of biotech stocks, they tend to have their profits that are coming in the future. Because many of them, they invest heavily in new technology. So in the initial years, they are not profitable. And they tend to be small to medium size. And the money only comes in the future. So with high interest rates, these biotech companies find it hard to get funding. They find it hard to raise money. At the same time, their valuation drops because of a higher discount rate caused by high interest rates. So in the last couple of months, biotech companies have suffered because of high interest rates and high inflation. And when they suffer, other companies that provide services to biotech and pharma also suffer. For example, would be diagnostic equipment companies like Thermofisher, for example, analytic instrument companies, life science solutions companies. So companies like Thermofisher, Viva Systems, MedPace, these companies are very, very good companies, but in the short term, they've been hit because of lower demand for their products and services because of biotech going through a rough patch, as well as some of the macro uncertainty going on. Biotech funding has come down. Again, the question is this temporary or permanent? The answer is it's temporary, right? Because once interest rates start coming back down and inflation beginning to moderate, biotech funding will come back again. Biotech will start to outperform, and then all these related companies that provide services to biotech will outperform as well. Now, exactly when it's going to happen, I can't predict. Could be a month from now, could be 3 months from now, could be 6 months from now, right? But it will happen. The tide will turn. But in the meantime, because of that, many of these companies are selling at the cheap, and that's where, as a value investor, you can find opportunities. Okay. Reason number 4 is because of post-pandemic adjustments. So during the COVID pandemic of 2019 and 2020, companies that manufacture vaccine equipment as well as diagnostic equipment as well as COVID-19 testing equipment, their sales and profits went up significantly. So again, like BDX and TMO had this surge in revenue and profits. Now that COVID-19 is over, they are now normalizing. So revenue has been dropping, profits have been dropping to normalize back to their pre-pandemic levels. And so that has caused the sell-off in some of these healthcare stocks. The other reason is because of the easing of procedural backlogs. So during COVID-19, many people who wanted to go for elective surgeries, they had to defer and delay their surgery because the hospitals were busy with COVID-19 patients. Now that COVID-19 is over, many of these patients are now going for these elective surgeries and they are claiming from their health insurer. So because of that, there's a sudden spike in medical utilization when people go for surgeries and they claim against the insurance. And that's why the insurance companies, their profits have dropped temporarily because of this surge in claims post-pandemic. And that's why we've got a short-term drop in profits from these health insurers, like again, UnitedHealth and Elephant Health, causing the share price to decline. So again, is this a permanent thing or is it temporary? The answer again is temporary. It is basically the post-pandemic adjustments. But once everything normalizes, revenue, profits, and margins will start to expand. So this is a shorter-term chart that plots the S&P 500, which is over here, versus the XLV ETF, which is the healthcare ETF. And you can see, like I said, most of the time, the healthcare or XLV tends to outperform the SPY. Where you can see this red line. Is that red or magenta? I don't know. Not very good with colors, right? So you can see that, yeah, the healthcare tends to outperform the S&P, red line above S&P, red line above S&P, healthcare above S&P. Most of the time, it outperforms the S&P 500. But again, in the last 12 months, you see what we call a divergence, where the S&P is going up, and although the S&P has dropped, it has recovered more than half the losses. So the S&P is overall still up here. But look at healthcare. You can see healthcare has gone down versus the S&P. So we call this a big divergence between the S&P 500 and the healthcare sector. And will this divergence start to revert back to the mean? Yes, it will. So you can bet that in the next few months, healthcare will begin to go up and overtake the S&P 500. Now, exactly when is it going to happen? I can't predict, but there will be that ultimate mean reversion. So now, if you look at healthcare stocks, there's a great opportunity if you buy either the healthcare ETF or you buy the highest quality healthcare stocks. You can see potentially a big return versus the S&P 500 in the next couple of months. In the longer term, which is the next 5 to 10 years, you can expect healthcare to continue to outperform the S&P 500 as it has in the past. Why? Because again, you have got four main structural tailwinds for healthcare stocks. Number one is the fact that we have got a global aging population and rising healthcare demand. The global population is aging rapidly, particularly in developed markets like the US, UK, or Singapore, or Europe. And by 2030, the US Census Bureau projects that 20% of the population will be over 65 years old. And this percentage will keep growing over time. In fact, there will come a day where probably like 40% of the people around will be above 65 years old. Number two is the rising prevalence of chronic diseases, unfortunately. So chronic conditions like obesity, diabetes, and cardiovascular diseases are increasing globally due to urbanization, lifestyle changes, and the fact that we are living longer. And the CDC estimates that 60% of US adults will have at least one chronic illness in their lifetime. Pretty scary stuff. So please take care of your health. The third reason is AI advancements will be significantly applied in medical innovation and technology. And it's already happening where they're using AI to create new drugs more rapidly and to improve patient care. So breakthroughs in biotechnology, personalized medicine, gene therapy, and AI-driven diagnostics are transforming healthcare and again generating that very high growth rate moving forward. The global biotech market, although now it's down temporarily because of high interest rates, which I mentioned, but is projected to grow at a compounded annual return of 13.9% from 2023 to 2030. So biotech will be one of the growth engines, and companies that are involved in supporting the biotech market, which are again medical devices, medical equipment, they will all benefit from this. Fourth reason why it's a good idea to have some healthcare stocks in your portfolio is because healthcare stocks are defensive by nature. What does that mean? That means that healthcare stocks are recession proof. They are essential things that people need. Again, no matter how bad the economy is, you gotta go to the hospital, you gotta take your drugs, you gotta have your medical equipment. So if the economy slows down and the US does go into a recession, likely healthcare is going to save your portfolio's ass. All right, healthcare would usually outperform in times of recessions, in times of economic slowdowns, and especially once and if, or not if, when the Fed cuts interest rates, healthcare, especially biotechnology and related companies, will then have a very strong rebound. Now, if you want to take advantage of the temporarily undervalued healthcare sector, you can either buy the healthcare ETF like the XLV or buy individual healthcare stocks. But the important thing is if you buy individual healthcare stocks, only buy the high quality businesses, because these are the ones where the share price will rebound back once sentiment shifts. But if you buy stocks of low quality businesses, then these stocks can drop and never come back. Remember, cheap crap is still crap. So you always want to look for quality first. What makes a high quality business? There are four main things that I look at. Number one is the predictability of the company's sales, profits, and cash flow. It must be predictable. In other words, in good times and bad times, their revenue, profits, and cash flow must be resilient. It must keep growing regardless of the economic situation. So we call that predictability. Number two is profitability. How profitable is the business? And one way we measure this is using return on equity, as well as return on invested capital. So you can see the return on equity over here and return on invested capital. We want it to be ideally above 12 to 15%. That is a high profitability company. The next thing that we look at is growth. Obviously, we want to make sure a business is able to grow in the future, grow their revenue, their profits, their cash flow. That's the third criteria of a high quality business. The fourth is what is known as the economic moat of the company, which Warren Buffett has coined. And this is what we call the sustainable competitive advantage. So a company that has got a moat, which means the company is able to protect itself from competition. Competitors are not easily able to take away their customers and their market share. So I generally like to buy companies that have got either a narrow moat or a wide moat, but avoid companies that have got no moat. Moat means the company has no competitive advantage. It competes on price and can easily be disrupted by competition. So avoid no moat companies at all costs. The fourth criteria I look at is financial strength. I only want to invest in companies that are financially very, very strong. So what is one healthcare company that meets all these criteria? UnitedHealth Group, which is a managed healthcare company that includes both health insurance as well as managed healthcare services. So you can see UnitedHealth Group ranks either medium or high on all these criteria. It is highly predictable. Why is it highly predictable? Well, if you take a look at their financials, you can see that their revenue or their sales revenue grows consistently over time, right? They generate more and more sales, and you can see their net income, their cash from operations, and their free cash flow is generally on an uptrend. So yes, it goes through ups and downs, but generally revenue, profits, cash flow goes up. So that makes the business very predictable. It does well under all kinds of economic situations. The second is it ranks high on profitability. Why? It's got a high return on equity of 24%. So again, I only like to buy companies where the ROE is generally above 12 to 15%. The higher, the better. Okay? Growth. Now, obviously, UnitedHealth is not a high growth company, not like Nvidia or Palantir with high growth, but it's a medium growth company. So it's got a medium term rank on growth. And how about the moat? Does UnitedHealth have a wide economic moat that protects it from competition? Is it dominant in this industry? We always want to buy dominant companies. Well, actually, UnitedHealth is a wide moat company based on the usual analysis. So for example, let me just show you. If I click on the economic moat of the company, This is using AI to analyze the moat of the company. You can see that UnitedHealth has got a wide moat that is scored 9 out of 10. So that is almost a perfect score in terms of their competitive advantage, the dominance they have in the managed care industry. Where does it come from? It comes from their brand loyalty and pricing power, which is 8 out of 10, high barriers to entry, 9 out of 10, high switching costs, 7 out of 10, network effect, 6 out of 10, and economies of scale, 10 out of 10. And of course, you can read all the explanations within the moat analysis. By the way, Stock Oracle is not yet released to the public. It's only released to a small group of my students who've been selected, but we will eventually release this Stock Oracle to the public in the next couple of months. So do be patient before it comes out. However, my team of analysts, we have decided to put UnitedHealth as a narrow mode company and not complete wide mode, because there is still some restrictions on the pricing they can place on their premiums because of government regulation. So because of that, we decided to be more conservative and put a narrow mode instead of the usual wide mode that is analyzed using AI. So we have that discretion to be more conservative. So based on this, UnitedHealth looks like it's a pretty good business. Then you may say, okay, if it's a good business, why is the share price falling like crazy? Okay, so let's take a look. So if you look at the charts, you can see that looking at the daily charts, UnitedHealth has dropped pretty significantly from the high all the way down, and it's down like about 39% from the highs. And in fact, in the last few days, it has been dropping relentlessly, and people are panicking like, oh my God, what's happening to this company? Should I panic and sell? Should I buy more? What should I do? So again, when you see the stock of a company dropping like crazy, the most important thing is to look at the business and to ask yourself, the business, again, are the sales growing? Are the profits growing? Is the moat strong? And if it is, then the share price dropping is an opportunity. And the reasons it drops, the reason the price drops, is it a temporary reason or is it a structural long-term reason? Now, if it's a temporary reason, then it's a great time to buy, because you buy a great company when it is hated. When no one wants it, that's when you buy it cheap. But if it's a long-term permanent reason that's affecting the stock price, then you don't want to buy it. So again, the question, is it temporary? Or is it permanent problem that's causing the stock price to drop? That's where you have to do your deep dive research into the business. Now, if you're very lazy, you can use my research, right? So that's why we've got thousands of people now who are subscribed to the Ultimate Investors Playbook, where they get access to my latest research on all these high quality companies, and they get my instant notifications when I'm buying and when I'm selling the stock. Okay, so by the way, let me do a disclaimer. I sold all my UnitedHealth shares back in early March. Let me just show you my notification to my students. There it is. Sorry, February, my bad, right? So you can see on the 21st of February, I shared that I was selling UnitedHealth and I sold my entire position at $440. So I got out of UnitedHealth. Now, generally, I only sell a company if I feel there's a long-term structural problem, or if the company is accused of fraud, I get out. But if it's a short-term problem, I don't get out, I buy more. So at that time, because UnitedHealth was sued by the Department of Justice for fraudulent activity, and I said, oh my God, fraud, I sold everything. However, after selling at $440, I have recently started buying it back. I haven't bought it all back, I just bought a little bit back, but I'll be looking to buy more back in the next couple of days or weeks, depending on the market situation, right? So why did I buy it back? Because it turns out that there was no evidence that the Department of Justice found in their investigation of UnitedHealth. So this was updated in the media. A court-appointed special master has found that US authorities do not have evidence to support their billion-dollar fraud case against UnitedHealth of keeping overpayments from the government for patients on its Medicare insurance program. So in other words, they're cleared of fraud. I thought, okay, there's no more fraud. It looks like a short-term problem. I'm buying my stock back now that it looks very undervalued. So what's the intrinsic value of UnitedHealth? You can see the intrinsic value is $570. This is based on my own team's valuation of the business. And again, using Stock Oracle, you can look at all the different ways you can value the stock. As you know, a stock can be valued using discounted cash flow, discounted free cash flow, discounted net income, mean price to sales ratio, mean PE ratio. There are many ways to value a stock, and different stocks are best valued in different ways. And you can see that my team of research people, we tend to put a very conservative valuation. So although most of the methods show that UnitedHealth, the intrinsic value is 746, 639, 658, thereabouts, our valuation is $570 per share, which at today's current share price at 380, it is quite undervalued. So if this is such a great company, why is it so undervalued? Why do people, hate it so much right now? So again, are these temporary or permanent reasons? So the great thing is that if you subscribe to the Ultimate Investors Playbook, you get access to all our research, our latest research articles on all these companies. So let me show you the latest research on UnitedHealth and reasons why it's been recently crashing the stock price. So there are primarily three reasons why the stock price has dropped significantly. The first reason is purely emotional, which is a sentiment shock when the CEO of the UnitedHealthcare group, or one of the groups of the company, he was shot, he was murdered. And this created a lot of negative attention around the systemic flaws in the US healthcare model, and this intensified scrutiny on insurance like UnitedHealth. Now again, this is not a company issue, it's an industry issue, but because of this sentiment, the whole market dropped. Elevance Health, UnitedHealth, all related companies dropped. Again, is this a temporary issue or permanent? It's temporary. Yeah. Second was the cyber security breach. So last year there was a ransomware attack on UnitedHealth that disrupted their medical claims and electronic payments, driving a temporary fall in earnings per share and fall in free cash flow. More importantly, management has already baked these one-off costs into 2024 and reset 2025 guidance accordingly. Again, cybersecurity attack, temporary or permanent? Temporary. But the third reason is the biggest reason, which is recently their revenue and profits were below expectation, which is very rare for this company. Usually they overperform, but recently they didn't meet the earnings and profit revenue expectations. Why? Because of a sudden spike in utilization. So what does this mean? So what happens is that millions of people, they pay premiums to these insurance companies. And if they need to get a surgery done, they go for surgery and they claim against the insurer, correct? Now, the problem is that, again, like I mentioned earlier on, during COVID-19, 2019, 2020, many people who needed to do surgery and elective surgery, they had to postpone it because the hospitals were too busy with COVID-19 patients. Now that COVID-19 is over, many of these patients are now going for surgery, which they postponed. So because of that, there's a sudden surge in medical utilization, which they then claim against the company. And that increased the cost of the company temporarily, and the profits dropped temporarily. So again, is this a permanent issue or temporary? Temporary because of a short-term spike in medical utilization. At the same time, inflation caused the increase in medical costs that also caused their profits to drop. Again, all this will be resolved in the next 1 year. Why? Because once the backlog of medical procedures are done, the utilization rates will drop back to normal, number one. Number two, UnitedHealth has the pricing power to raise their premiums to offset the increase in medical costs due to inflation. And all this will be resolved in the next couple of months or next 12 months. So because of this, margins have compressed in quarter one of 2025, but they're all fixable by 2026. And how are they fixable? Again, by pricing resets starting in 2026 as they start to readjust their premiums to offset for the high medical costs. Number two, cost containment through integration with their Optum platform. And number three, improving cost leverage. So in other words, UnitedHealth is able to use the latest tech investments, especially in AI and ongoing productivity improvements, to lower their cost leverage to increase and to optimize their margins moving forward. So going back to the charts, you can see that UnitedHealth is now trading at $380, which is over 30% below its intrinsic value of $570. So it looks very undervalued, but of course, the question is, how much lower can it go? People always say, what if it goes lower? Now, we know that there's no way to predict exactly when the price will bottom. As long as we buy it when it's undervalued at a support level, we know that over time, it will rebound back to its intrinsic value and higher, and we'll do very, very well. But to predict the exact bottom, it's impossible. And that's why for me, when I buy, I never buy all at once because it may not be the bottom, right? But I always buy slowly by averaging in my position in tranches, and I buy at support levels. So currently, you can see that the recent support is at 387. And we could see a rebound from that support level, or it may even test the next support level, which is at 366 before reversing higher. So there's no way to predict, but as long as it is near or below support levels, I would average in the position, because once it reverses back up, the rebound can be quite sharp. And when people say, hey, I want to wait for an uptrend to buy, yeah, you can. But by the time it's on a confirmed uptrend, it would have already moved 25 to 40% above the lows, and it's no longer that undervalued anymore. Now, some of you may look at a chart and may think, hey, this looks pretty scary, right? The price just keeps dropping. But remember, if you look at the long-term chart of a great business, this is not something uncommon. So let me show you the long-term chart of UnitedHealth. And this is the very long-term chart. Let me kind of like remove the moving averages so it's a bit clearer. And let's go back to that long-term chart over there. Okay, there we go over here. All right. So you can see that along the way, this business, it has gone through drawdowns before. Right? I can see it dropped 56% over here. It dropped 60% over here. And this was the great financial crisis. And this is a financial stock in a way. Is health insurance, is health plus financial. You can see it dropped 76%. So, but I don't anticipate that. This is not a financial crisis, okay? This is just a normal correction. In fact, this is not even a bear market. And so right now, it has dropped 39% from the high. And if you ask me, my guess would be we are pretty near the bottom. And it's a matter of time where in the next couple of weeks or months, we should bottom and it should reverse back higher. Once again, remember, this is not a recommendation for you to buy this stock. This is shared purely for educational purposes. This is a stock that I have started buying back very recently, and I intend to buy back to a full position in the next couple of weeks or couple of months before it fully rebounds back. Now again, besides UnitedHealth, there are many other high quality healthcare stocks that are also very, very cheap right now. I don't have the time to go through all of them. You can see it takes quite a bit of time to just go through one of them. If you want to find out more and get access to our deep dive research and my instant notifications of when I'm buying, when I'm selling, do check out the Ultimate Investors Playbook, which you can find at insight.piranhaprofits.com. Thank you for watching this video. Hope you enjoyed it. And as always, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.